In this week's video, we'll review the latest charts and data. Help us answer the question, what is driving the outlook for stocks? Growth or inflation? We'll be moving quickly, so feel free to use the pause button on your video player. Is the stock market concerned about inflation? Of course the stock market's concerned about inflation, but that's not the real question here. The question is, are concerns relative to inflation, interest rates, Fed policy, fear of a recession, etc., greater than growth expectations looking out 12 to 36 months? And as of the close on Friday, January 10th, it's fairly easy to examine those questions and answer them, so we're not going to make things more complex than they need to be. This is SPY, the S&P 500 ETF during the trading session on Friday, January 10th. You can see we're coming back and retesting the election gap, which really shouldn't be surprising to any of us. We mentioned that gap way back on December 18th and as far back as December 10th. Good to keep in mind that numerous ETFs still have large post-election gaps below price. We know markets like to fill gaps and test gaps, and we also know that tests can either pass or fail. As of the close on Friday, we're still passing. The test is still in progress. SPY closed right in this area here. It's also noteworthy what once acted as resistance, this intraday high here from July of 2024, this high here from August of 2024, eventually what once acted as resistance started to act as support in September and October, and again in November. All of this consolidation up here is occurring above these levels that still represent areas of possible support below price, and all of this consolidation is occurring within the context of an upward sloping 150-day moving average in orange. That's where the market held and made a stand in August of last year, and above an upward sloping 250-day moving average in black. We're not making any assumptions about what's going to happen next. We'll learn something either way. We know markets don't like to make things easy on anyone, and markets often like to overshoot. So we shouldn't be surprised if we see price or SPY in this area here. The longer below the blue lines, the more concerning it would become. A short stay, 1 to 5 trading sessions, not particularly concerning. Also noteworthy, see this upward sloping line here, the blue line? If we take a big step back, Friday's intraday low here aligns with the intraday low during an overshoot in August of 2024. I believe this is August 5th. Also aligns with the intraday low back in October of 2022. Nothing magical about trend lines. You can overshoot them. We overshot a trend line in here, and eventually the uptrend resumed. Testing trend lines and breaking trend lines, that is indicative of a waning trend. It helps us keep an open mind about worse than expected outcomes. But for now, this looks like a retest of the election gap. And as long as SPY and the S&P 500 stay in this general area, we don't have a lot of evidence saying the trend is rolled over yet. Obviously, that's subject to change. Covered this chart numerous times. This is the rollover in the early stages of the 2022 bear market. This is January of 2022 here. You can see we broke a similar trend line. Breaking of the trend line, not earth-shattering, but you do learn something. And eventually we came and undercut these anchored volume-weighted average price lines that were anchored to points roughly a year earlier. If we look at something similar during the trading session, during the sell-off on Friday, January 10th, these are similar anchored volume-weighted average price lines. This is January of 2024. If we follow them forward, it's the purple line and the blue line. You can see during Friday's session, unlike Q1 of 2022, we were well above those lines. The VIX was relatively tame during Friday's session. Intraday, it was up about 3%. I believe it finished in single digits, up about 8%. We can learn something or gain some additional insight into the market's expectations regarding expanding liquidity or expectations related to the contraction of liquidity by looking at the ratio of Bitcoin to the S&P 500. And that's what we're looking at during the trading session on Friday, January 10th. And if you don't like the term liquidity or you don't think it applies, we can flip it into this. You can follow this ratio to monitor the market's appetite for risk or lack thereof. Let's go over the left side of your screen over here. You can see the ratio of Bitcoin to the S&P 500 was clearly falling well before the COVID crash here in 2020. Bottom of your screen is the S&P 500. Now, if we move to the middle portion of the screen, something similar was happening here. This is January of 2022. This is a lower high in the ratio relative to this high from 2021. Again, downward sloping. This is Q4 of 2021. The S&P 500 didn't peak until early January of 2022. So this happens before COVID. This happens before January of 2022. And then it gets even worse during the bear market. This and this happened before this peak here in the S&P 500. S&P didn't bottom until October of 2022. It's also noteworthy, right in here, again in Q4 of 2021, the ratio gaps down when the Fed starts to signal to the market that it may be getting ready to raise interest rates or tighten liquidity, or pull liquidity out of the system. And notice this gap down occurs before January 1st, 2022, when the S&P 500 peaked. And also notice, during the bear market, the ratio never really even made an attempt to get on the other side of this gap from late 2021. And after that gap, really bad things happened in both the ratio and the S&P 500. It's also important to keep in the back of your mind that prior to January of 2022, again, the ratio makes a discernible lower high relative to this high in 2021 earlier in the year. That's not what we have in the present day. We just made a discernible higher high relative to this high from earlier in 2024. And in this case, we had a gap up at the election rather than a gap down. We have a gap down over here. We can never retake that gap when we have a bear market. Here's the election gap up. During the session on Friday, unlike the S&P 500, this risk on, one way to monitor the market's risk appetite, so a risk on, risk off type indicator, it's risk on when it's rising, it's risk off when it's falling, really isn't even threatening to test this gap yet, and that's a key term, yet. Also noteworthy, the ratio recently made a new all-time high right after the election. That's in stark contrast to January of 2022 here when the ratio is making new multi-month lows. So all of the warning signs that started to accrue, let's say in April of 2021, walking forward to December 31st, 2021, all of this deterioration, we don't really have any of that looking back several months. We also have a nice tight cluster in here when we're looking at the average price of the ratio anchored to key points. Notice those lines are upward sloping and the ratio is above them. It's not really what we have over here. In January of 2022, those lines are above us and they're either flat or downward sloping. That's in stark contrast to what we have over here. And if we zoom in into this area and we go back to the anchored average price lines for this ratio, this is 9 months here before the S&P 500 peaks in early 2022. And If we look at these lines here, you can see the ratio drops below in late 2021, before the S&P 500 peaks. If we look at similar lines in the present day, we go back 9 months, the ratio was well above them, and those lines were upward sloping in a bullish manner rather than turning flat here and rolling over as they did in 2022. Now, remember earlier we said the market rarely makes anything easy for anyone. Here's a scenario where it's possible to see SPY overshoot into this area here. Mentally, we need to be prepared for that. And if that does happen, we don't want to make an assumption that it's going to hold. We just know that that can happen, as it did here in August, and we don't want to overreact, but we don't want to underreact either. It's a neutral event until it decides what happens next. And hypothetically, if we did overshoot in the coming sessions or during that time, this ratio could come back and test the election gap. And if it held in this area here, a very, very logical region, that would still be good for the market's risk appetite. We'll see how it unfolds. Until things get better, we should probably expect them to get worse until the market proves something in the short to intermediate term. Keeping in mind that from a longer term perspective, we're still in an uptrend. The last thing SPY did was make a new all-time high. It really hasn't even made anything that's significant in terms of a new low. Let's revisit some charts that we covered in December and see if the message has changed. We covered this chart, large cap growth relative to large cap value. Covered this ratio in detail. This is from the December 13th, 2024 video. This was the chart we covered. This is the look that we want to avoid. This is January of 2022. You can see the ratio is plummeting. And when the market became concerned about inflation, interest rates, Fed policy, and slowing growth, this ratio dropped like a stone. Well, that's not what we had when we looked at this chart on December 13th. Thus, it wouldn't be shocking, based on the ugly session that we were having and had on January 10th, 2025, wouldn't be shocking if this ratio fell out of bed and dropped like a stone relative to January of 2022. So if we were to zero in on this look here from December 13th, has this look here morphed into something like this here? Is the 20-day moving average now on the bottom of the stack? Is the ratio of growth stocks to value stocks now below all the moving averages as it was very early in 2022? The answer to that question is no, not yet. This is the exact same chart pulled during the session on Friday, January 10th. During the day, basically a dead heat between VTV and SCHG. SCHG was underperforming VTV by 0.09%. And this is the look of the chart. This, with the ratio hanging around a still upward sloping 20-day moving average, doesn't look anything like Q1 of 2022. Look at the slope of the 250-day moving average. It's the dotted line right here in January of 2022. This is the line. It is clearly rolling over and downward sloping. We do not have anything even remotely like that when we look at the exact same chart here on Friday, January 10th. Obviously, that's subject to change. If this look up here morphs into something eventually that looks like this, concerns would increase. But we trade the chart in front of us. And this is the chart in front of us on Friday, January 10th. And if you walk forward and learn what the market looks like when it focuses on growth, what it looks like when it's confused, what it looks like when we see a shift where growth now takes a back seat to concerns about inflation, interest rates, and Fed policy. Similar situation. we covered the ratio of energy, XLE, to the S&P 500 in that December 13th video. And you can see in January of 2022, the ratio, first few trading days of the year, shoots up like a rocket. This is rising or escalating or spiking fears of inflation. And eventually, in January, the 20-day moving average looks like a SpaceX launch. It's not what we had over here in December. And that's not what we had during the trading session on January 10th, 2025. If we compare the look of the ratio relative to the moving averages on January 10th, and focus in on the 250-day moving average in the present day, the dotted line in black, and contrast it to the look in here where it's already rising rapidly in 2021 before the S&P 500 peaks. Right now, this look in here really doesn't look anything like the look of the exact same ratio during the sell-off on January 10th. If this morphs into something like this over time, concerns would increase. We'll take it day by day, but right now, the ratio of XLE to SPY is clearly in a downtrend, and it looks significantly different relative to January 3rd of 2022. All right, the market must be getting defensive. Institutions must be running for defensive staples. Probably didn't even want to look at this chart on January 10th. This is the look of it on December 13th when we covered it, and we said it really didn't look anything like this concerning look in 2008. This is XLP relative to SPY, and this is the concerning look here in Q4 of 2021 and early 2022. So December 13th of last year, this didn't look anything like 2022, and it didn't look anything like the turn in Q1 of 2008. How does the exact same chart look today? Better, worse, or about the same? It looks better if you're a stock market bull. During the session on Friday, January 10th, it was still down for the month. Defensive staples underperforming SPY by 1.99% on January 10th for the month, and down for the week, down 0.66%. Taken in isolation really doesn't mean anything, but group it all together with the charts that we've covered, and group it together with our model readings, and that starts to form the weight of the evidence. November 1st, 2024, before the election, you can see our models have very strong readings. They must have deteriorated somewhat, and they have, but not a lot. Right now, the trend strength is at 94, the long term is at 100, and these numbers have shifted a little bit, but not in a concerning or material manner yet. And yet is the key word. This is the data in front of us. This is the chart in front of us on January 10th. We'll continue to take it day by day and see how things evolve. Right now, this looks like 100% normal and to be expected volatility that can occur within the context of any uptrend. Even if good things happen for the rest of 2024, it's very, very easy to visualize overshoots or additional weakness and or volatility in the coming sessions and or weeks, or possibly even for Q1. We're not making that assumption, and we're not going to assume it's going to hold. And we all know the only way that we can use a chart or data like this effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.